It's the worst in 3 years. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have an industry crisis as this just plunged to its 3-year lows. And what this means for the U.S. economy, as you're about to see, is that we're no longer on track for a no landing or soft landing scenario. What it means is something far worse is coming. Now let's go to Bloomberg, where we picked today's story up with a headline: U.S. retail sales dropped by the most in nearly a year after the holidays, but it's even worse than that. It's actually now down to the worst in 3 years. And yet, what did we continue to hear from the political elite? That the U.S. economy here is rebounding, that the consumer is strong on the back of a robust labor market, and this should lead to further increases in spending. And we have noted that in the fourth quarter of last year, all of the resurgence in spending was debt fueled based on credit cards and buy now, pay later loans. And while the evidence that this is all coming to a halt is here. The value of retail purchases unadjusted for inflation crashed outright by 0.8% from December after a downward revision to the prior month. The drop was the biggest in nearly a year and has now taken the year-on-year rate of change down to the lowest it's been in 3 years. We have to start going back to the pandemic era to see data like this, suggesting that something significant has now changed for the U.S. consumer in a major way. As 9 of the 13 categories posted decreases, led by building materials, stores, and auto dealers. And while severe winter weather may have impacted the figures, now we've heard this before, is that the reason consumers didn't spend is, well, they just couldn't get out to the stores and shippers just couldn't get those packages delivered in time. What we're seeing is something fundamentally has changed in the U.S. economy. We'll talk about what that is in a moment. A sustained decline in sales would indicate that household spending is at a risk of deteriorating. Again, not something that the political elites want to see here, because consumers have so far supported strong economic growth and helped keep the U.S. out of recession, and at the same time kept the Fed keeping rates elevated, which we've been making the case here is a huge mistake by the Fed. They have absolutely no clue what they're doing. We have further evidence of that much later in today's show. But let's talk about what should be happening in retail sales, because in the U.S. we have what's called the wealth effect. As people feel wealthier, well, they tend to spend more, and the biggest barometer of wealth, that's the U.S. stock market. And what normally we see as a relationship between retail sales and equities is a fairly strong one, because again, as people feel their net worth going higher, well, they feel it's okay to go out and spend a little more. And we can look at downturns going back to the dot-com bubble, and we can see decelerations in retail sales. Well, that's soon followed by a deceleration in equity prices. And it really makes a lot of sense here, because as investors look for future earnings and revenue numbers to drive equity prices higher, well, when people consume less, well, lo and behold, the numbers for the stocks do not achieve what they need to, and prices start to come down. But keep in mind, right now, everybody is piling in the U.S. equity market on hopes of booming earnings. Well, the data is about to suggest otherwise. Even as we move forward into the global financial crisis, what did we see as the stock market started to lose steam? Well, so did retail sales demand. And how about post-pandemic, as people had less money to spend because the government stopped giving out money and the Fed started to raise rates? Well, what did we see? A massive deceleration in retail sales, and lo and behold, stock prices did follow until everyone started to believe we're at the cusp of the next big bull market in equities, and this was going to launch a 10-year rally in equity prices. Well, a big collapse in the year-on-year rate of change in retail sales now suggests otherwise, that this whole thing has changed its tune, and that something fundamentally here is wrong with the U.S. economy. And all the evidence we need, we've been talking about this, is total compensation growth, which we see here in red. And this is shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. We put that on a year-over-year rate of change. And what it's showing us is that total compensation growth is slowing at a time when inflation isn't slowing fast enough. So people are hoping to get bigger and bigger paychecks. And what they're noticing, the size of those increases is shrinking faster and faster and getting close to a contraction. And lo and behold, what do we find in the data? That as people have less money to spend every month, perhaps because debt service is back as these credit card bills come due and the buy now pay later loans also come due. Well, that means less retail sales spending as the discretionary side of the economy takes a hit. Sure enough, that's exactly what we see here as total compensation growth, shown in red, decelerates. Well, retail sales go down because people just have less money. And we can note that we tend to see it actually during periods of a recession. But look at right now, we saw a massive plunge in total compensation last month. And what did I say? Within 90 days, this was going to start to show up in the data. Well, in the retail sales data, it showed up instantaneously. On the same month, we see a big collapse in retail sales, suggesting that over the next several months, unless there's a big pickup in either hours work or wage increases to drive total compensation up, look for retail sales to continue to plummet. And the retail figures largely reflect purchases of merchandise, which comprise a relatively narrow share of overall consumer outlays. A separate release due later this month will show January spending on goods and services. Though it was adjusted for inflation, of course, the retail sales data isn't. We're going to fix that here in a moment. As Thursday's figures showed, purchases made at restaurants and bars, the only service sector category in the report, climbed a whopping 0.7% last month. Receipts at grocery stores rose by a similar amount, so we see people out spending more money on food and looking to enjoy the money they have, spending less money on other sides of the economy. But one thing we know is that people should have more money here because we give you all the tools you need to do that. Let's talk about our CTA Timer Pro report. This is a machine positioning. So we know that machines drive tens to hundreds of billions of dollars of money in the market. If you know where they're at, you have the advantage. We give you a report that shows you their positioning, but we run a historical overlay, which usually tells us we're ahead of where the machines go, and you too can also be in that position. Let's talk about our trade on QQQ because we had a big pullback in the market on Wednesday. How has this played out on our position? Well, we can go back to October 9th. We see we came off of a short covering position. This is what we noted to our subscribers, and now we've made it even easier. First page of the report tells you when signals are coming off that deep short position, tells you when it's time to look at putting a trade in. Pair that with our technical reports because many of you trade things like the MACD, the RSI, but you get in and out too early, too late. It's always in the wrong place. And what happens? We take that, smooth all that data out. We put in our Momentum Timer Pro report. Also on October 9th, what did we see? We went from a deep sell position on a technical basis over a 1 and 3 month window. We started seeing a change in momentum. That put a buy it open on our signals. You'd still be up 19.37% at the time we filmed this, despite the big pullback earlier this week. And what a fantastic move that would be, an opportunity for you to change how you trade, to give you the edge you need. There are links in the description below for 3 coupons for a free month for each report. Grab them while you can, because with where retail sales are going, well, people are going to be looking for money, and you're going to be looking as a king of trading. But let's talk about these inflation-adjusted retail sales numbers, now shown in blue, taking off that CPI data against total compensation. What do we see? Retail sales now contracting on an inflation-adjusted basis, just as there was hope for retailers last month. That has changed, and we noted this in those confidence reports, those survey reports that talk about business optimism, and we noted that, of course, business owners are less optimistic. They're seeing the dollar amount of their sales is looking better because prices have gone up, but the volume and foot traffic all headed down. This goes to show they're getting further and further behind, and with people having less money to spend, it's only going to get worse for them, and that's going to change the game for the U.S. economy in a big way. And after the unexpectedly surge in November, December, driven by a large part in food services, this from Zero Hedge, headline retail sales were expected to decline just 0.2%, but as we know, it dropped 0.8%. The worst monthly decline since March of 2023, the worst year-over-year rise back from 3 years ago, May of 2020. Now, a separate report showed that initial applications for unemployment fell to 212 last week, pointing to a steady labor market. Of course, that is the hope here, that it doesn't matter what happens in retail sales on a month-to-month basis because the labor market is strong and healthy. But what if that is about to change in a big way? Well, this is something neither the central elites or the political elites are ready for at all. And as you're about to see, a decline in retail sales is going to have a massive impact on the labor market. Now let's take a look at the details of the report, because yes, initial claims rose 212,000 last week, sliding 8,000 from the week before. That's a good trend. Super low numbers. On a non-seasonally adjusted, these are starting to get back in line. 222,000 last week, but here we see the change. Look at the seasonally adjusted continuing claims data, up 30,000 to 1.895 million Americans. We see on a non-seasonally adjusted basis, that's up to 2.14 6 million Americans. And that is the issue here, because when people spend less in the economy, well, employers need fewer people to actually transact all of the business. That leads to people getting on the unemployment line. And as we're seeing, they're getting stuck there. And the longer they get stuck on unemployment, the less money they have to spend in the real economy, the bigger impact all of the debt service and higher prices has on their bottom line. Because in the end of the day, well, we know that unemployment pays a lot less than full employment. But one thing we can look at, say a little bit of optimism. Total claims down to 2.16 million against a 52,000 drop week before, but it's those continued claims that we're worried about. And here's why: because what you can see is a deceleration in retail sales as shown in blue. Well, that matches up with a rise in continued claims shown in red. And sure enough, what we can expect and what we saw in the data last week is this downward move in retail sales did lead to an increase in people on continued claims, suggesting they are having a great amount of difficulty finding more work, putting them again on the system for longer. That will have a massive impact on demand from the U.S. economy, and in turn lead to more and more layoffs. And then, of course, where we see that go, well, then it hits the factory sector, as we saw today. As U.S. factory production declines for the first time now in 3 months, no surprise, as consumers have less money to spend, well, demand goes down, and sure enough, we see that in retail sales. And how does that then turn into, of course, the factory sector? It's very simple. As retailers are moving less product, well, they order less, and if they order less, the factories, well, they get turned down a little bit. And sure enough, we see a 0.5% decrease in factory output following a 0.1% gain the month earlier. Total industrial production, which includes mining and utilities, fell 0.1% in January, but it gets worse because production of motor vehicles and parts slipped 0.2% after rebounding strongly in the prior 2 months after the UAW strike ended in October. Excluding autos, manufacturing decreased 0.6% in December, taking a massive drop, the biggest, in fact, since March, and the fourth straight monthly decline. But recent surveys suggest the worst is coming to an end as the ISM factory index climbed to a 15-month high in January, as the largest share of purchasing managers since April reported higher orders. Again, that was preliminary data. We'll be very curious here actually to see the next signal out. That was the official report. We'll look at the preliminary data coming soon and see if that's changed. Maybe they're just seeing an increase over the prior month, and that got reflected into a huge surge. Maybe it's not a volume, but just a number of increased orders. But let's take a look at industrial production, because we know it has a very strong link to advanced retail sales. Here you see blue against industrial production in red. And sure enough, where retail sales go, industrial production tends to follow, suggesting that in the months to come, we're going to see industrial production further head into contraction territory here. And that means, of course, the equity markets may have this one completely wrong as investors look for big earnings to drive equity prices higher. Well, you'll note that when we see industrial production turn down, it generally means equity prices start to turn down. Not in every case, but in most cases, here you have a big disconnect as equity prices are hitting new all-time highs at a time when industrial production is slowing, suggesting that companies are not going to be turning in some massive profit numbers that the equity market needs them, unless it's followed by a lot of layoffs. But as we look deeper into the manufacturing sector, what do we find? Again, further signs of slowing demand. Here we see from Zero Hedge that capacity utilization for manufacturing decreased to 76.6. This is a percentage of a factory that's being utilized, a rate that is 1.6 points below its long-run average, now the lowest since September of 2021, suggesting the percentage of a factory that's getting used is decreasing. Again, a sign that demand is going down and that all of them back feeds into the labor market. Here you can see capacity utilization in blue against continued claims in red, and you note this looks like a pretty mirror report of each other, and sure enough, decreases in factory capacity lead to increases in people on getting on unemployment and staying on there. That suggests that there's any hope that we were going to see these continued claims numbers go down, which is what the Fed suggested was likely to happen here, is unlikely because what we're seeing in the factory sector is demand continue to decrease. We're seeing less of the factory being utilized, and when you have less factory being utilized, well, you need less people to utilize that factory. Let's take a look here, because the big question, which we will have in the weeks to come, hopefully an answer to, is why the purchasing managers indices are saying, yes, there's a strong rebound, and industrial production saying, well, no. One of them's likely to be wrong, one of them's likely to flip, and based on the retail sales data, well, we can kind of start to glean that perhaps those purchasing managers were a little more optimistic than they actually have the data to support. But does this mean, of course, the Fed's going to change position? Well, no, but wait till you see they kind of admit that they really don't know what they're doing at all. As Fed's Barr says he supports Powell's careful approach to rate cuts, this is important to see. As Chair Powell indicated in his most recent press conference, my FOMC colleagues and I are confident that we're on a path to 2% inflation, but we need to see continued good data before we can begin the process of reducing the federal funds rate. Again, if you're seeing retail sales go down, that means demand is going down. And we talked in the show yesterday that in Europe, they finally believe that supply is outpacing demand. Well, you're going to see that happen here in the U.S. That will bring inflation back down to target and even below. But don't ask the Fed, because they're not sure about this yet. He goes on to say, I fully support what he calls a careful approach to considering policy normalization, given current conditions, which translates to we're just going to continue to do nothing and hope that everything works out. Well, that's not exactly how it's going to be. Because given the limited historical experience with growth and inflation dynamics we currently face, and no modern experience of emerging from a global pandemic, so here you see that Barr's really kind of, lifting up the curtains here and saying, look, this still situation, we don't really know what we're doing. We've looked back to the 70s and all we saw is inflation came down and we took off again, and that's become our base case. They don't actually even understand what caused inflation in the 70s to begin with. They don't even understand the global monetary system, let alone how our system works. And so all they've done is keep rates elevated because all they're afraid of is a repeat of the 70s, even though as we made the case, there's no chance of that at all. And yet he says we have another reason to proceed carefully, as we have been doing that because we're just so afraid inflation's magically going to come back. But he emphasized we're not targeting subcomponents in the economy. In fact, we just want the overall economy to come down to our target, which is exactly what the case I've been making, is they want to see demand come down in a big way. They want to slow the economy down. That means any hopes for future wage gains are gone. Any hopes that we're really in the beginning of a bull market are gone, because when the Fed gets too aggressive, as they have, and they constrict the creation of credit for a long period of time like they're doing, well, it means there's only one direction we head, and that's into a recession. And that's at best case scenario, because we can look back and see the Fed should be cutting by now. As we look at advanced retail sales still in blue against federal funds rate in red, what do we know? The decelerations in retail sales usually follow a cut in the federal funds rate. And it would make good sense here. How do you get people to go out and buy things they don't need with money they don't have? Well, it's real simple. Lower interest rates works a lot, but it's too late now for the Fed. How about industrial production? Here you can see decelerations in industrial production usually are indicating that the economy is slowing down. The Fed, if they don't cut ahead of time, they're cutting after that, suggesting right now, as we know, retail sales leading industrial production, that's going to fall off the cliff. The Fed is going to be forced to cut in a matter of months, even though they don't like it. But how about capacity utilization? Here again, you see the Fed leading oftentimes capacity utilization to the downside, and when they don't, they quickly chase it, suggesting that again, they should be trimming the federal funds rate at least a little bit here. But as we know, they have no clue, again, how the system works. What we're going to find out is over the next 90 days that the slowdown in total compensation growth, which just impacted retail sales and starting to impact industrial production, is going to lead to a further increase in layoffs and people staying on unemployment. And that, my friends, will be the end of this next economic cycle as we then start to talk about how fast the recession is going to hit. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.